This video will discuss how to trade support and resistance. That video is about the never-ending war between bulls and bears. This is how my website looks like. It's www.monkeymakesmoney.com. On that website you can start subscription of my proprietary trading view indicators. Before I start that video, please read that important disclaimer. You can follow signals produced by my indicators on Twitter. Just find an account Monkey Makes Money. We will be talking about daily support and resistance, levels that are calculated by one of my most powerful indicator, which is called CAD Cycle Trader Indicator. That indicator draws several lines on charts. The lower red line is the daily resistance and the upper blue line is the daily support. So you can see that it draws actually two red lines, lower one and upper one, and two blue ones, lower blue line and upper blue line and lower blue line. So those two lines in between form so-called a daily range, and we are formed by daily resistance and daily support. And the indicator plots numbers referring to those resistance and support levels in the right upper corner of your screen. The main function of the CAD Cycle Trader Indicator is to identify an underlying cycle and draw support and resistance, and in addition to that it draws trading signals. And today we will be talking about additional feature of that same indicator. So this is the huge menu. You can just double check any element drawn by that indicator and you will get to that menu. And if you uncheck everything which basically that indicator does and leave only one option, which is called critical support and resistance, this is what then you will get the subject of today's video. First, let's talk about a market, a range-bound market. When price spends a day bouncing in between the daily resistance and support, we do not have trending conditions that make trading easier. We get range-bound or whipsawish market. This is one of the examples. You can see that price opened a day inside the range in between the daily resistance and daily support, and it kept moving sideways until it almost tested the daily resistance, and because bulls failed to break over the resistance, bears stepped in and pushed price down. And this is a great example of that never-ending war between bulls and bears. So think about all those lines like a battleground. Bulls and bears, they compete for taking over those lines. And if one party fails, that another party counterattacks and try to push price to another level. And this is an example. So they tried to push price into the daily resistance, they failed twice, and then bears counterattacked. We pushed price down once, failed, price bounced, then bears pushed again, we pushed it down into the daily support and price bounced up again. That's another great example that when price opens the day inside the range, so the range is formed by daily resistance and daily support, bears will be attacking the daily support and bulls will be attacking the daily resistance. And we could spend a day or even couple of days when price is consolidating in that range and bulls and bears would be unable to push price out of the range until at the end one of the party would prevail. And in that particular case you can see that first support was tested, then bulls failed halfway up to the resistance, then price dropped again strongly, but again it stopped right at support, and then another strong push up into the resistance, bears failed here, and finally we got a very strong decline. Again, those lines are drawn by CAD Cycle Trader Indicator. When price opens the day inside the range and bears attack the daily support, like here you see bears actually failed 3 times, If bears failed, that failure inspired bulls to start a bullish attack, and that was a great example. You see, they tested the support, the upper blue line, twice pre-market, and then one more time at the open. They failed at the open, and this is when bulls came up and we pushed price trying to reclaim that red line. So those red lines are targets for bulls, and those blue lines are targets for bears. When bulls attack the daily resistance but fail to break out, like here, that failure provides bears with opportunity to push price down to test the daily support. When price opens a new evening session after 4 p.m. Eastern Time under the daily support, like here, you see price starts a day under the open support. That daily support turns into resistance, and in that particular case you can see that price tested it twice and bulls failed both times. We pushed it overnight, we failed, price dropped. We pushed it once again at the open of the morning session at 9:30 a.m. Eastern Time, and price dropped again, and it tested the secondary support, the lower blue line, and we will be discussing that line later in that video. In the same way, if price opens the trading session over the daily resistance, you see this is the daily resistance, and price opened up the new session over that level, so that daily resistance turns into a daily support. It becomes a strong support for the whole day. You can see that that level got tested twice, first in the morning and second in the afternoon, and in both cases that level of support held. The same story happened the following day. Price opened up over the daily resistance and it turned into support, and then that level got tested twice, in the morning and in the afternoon, and because bears failed to reclaim that level, failed to push price under that level, that was a very bullish sign, and this is when bulls stepped in, they turned price up, and they started a new powerful attack that reached the second red line, the upper red line, which is a secondary resistance, and we will be talking about that level in a couple of minutes. And another day, and the same story. You can see that price was trading overnight over the daily resistance. It dropped pre-market, then bulls reclaimed that level. Price came back down again retested that daily resistance, which turned into support and pushed up again. If price opens a trading session over the daily resistance level, that level turns into a strong support. And this is yet another example of NQ Mini. You can see that price was trading sideways over the night, and in the morning, bears attacked that level. They overshot it, but that weakness got bought out, so that level has held. And bulls immediately started to push up again. They failed, they pushed it almost up to the secondary resistance, move up, stop, price dropped down again, and look again where it stopped. It stopped at the very same level, at the daily resistance, that turned into a daily support. In a downtrending market, bears normally keep price under a daily support, which is upper blue line, all the time. This is why in a downtrending market, the daily support, the upper blue line, often works as a daily resistance. Think of a broken support that turned into resistance. Question: if in a downtrending market the daily support works as a resistance, what level works as a support? And here we should discuss the secondary support. At the beginning I told you that the indicator draws two red lines and two blue lines. The upper blue line is the daily support. But what if price opens under that level and bulls are unable, they keep failing at that level? So where we should expect price to find a support? And this is where the second lower blue line comes in handy. This is so-called secondary support. In that particular case, you can see that on that day when price failed to when bulls failed to push price over the daily support and resistance, price ended up the day at that secondary support. Here is a similar example but with secondary resistance. You can see that price opened up that session over the daily resistance. It got tested several times. Bears failed to push price under that level, so bulls stepped in. They stopped pushing price higher, and look where we pushed it. We pushed it up to the secondary daily resistance. That line does not mean that bulls would fail at that line. In this particular case, you can see that we pushed price a little bit higher than that level, but then it dropped back under that level. When price opens a new morning session under the daily support, that level turns into a resistance for that day. You see we have two blue lines, upper blue line, which is the daily support, and this is the secondary support, the lower blue line. And you can see that price was trading around that secondary line overnight until 9 o'clock in the morning, New York time, and this is when bulls stepped in. They started to push price high, and look where they failed. We managed to push price up to the first daily support level, but because we started the day under that level, now that level for them becomes a daily resistance, and this is exactly where we failed. And look how price strongly dropped back down to the secondary support. And you should note that once price reaches the secondary support, bears are running out of steam, running out of gas. We are getting exhausted. This is why very often when you are short, it makes sense to start closing your short positions once price reaches that secondary support level. This is another example. You can see that in the morning, price dropped under the daily support. Then at open of a daily session, bulls tried to recapture that level. We failed right at the daily support, and their failure immediately inspired and attracted fresh bearish bets. And look how strongly price dropped, and look where it stopped. Again, it stopped at the secondary support level at the lower blue line, and price bounced up again and dropped again. Even though bears managed to overshoot that level, we could not have any follow through to go much lower than that lower secondary support line. So we consolidated a little bit, and then price bounced up again. The same story the following day. We can see that price tested the secondary support. Bears managed to overshot that level, but not for a long time. They only held the price under the secondary support for 1 hour, and then price, like a ball from underwater, jumped out of the water and came back into that range. And in a downtrending market, the daily range again is formed by the daily support that turns into resistance and the secondary support that in fact becomes a support for the day. And it's very interesting that here 2 days we could consider them as downtrending days because the daily support, upper blue line, it worked as resistance. But the following day we got a new range, and under that range now resistance came down and support came down, and the next day price actually spent inside the range. You can see that bulls tried to break out twice, one time overnight and another one pre-market. They failed both times, and then price dropped strongly. Where it dropped? Right into the daily support of the day. The main conclusion is that the secondary support, the lower blue line, is capable of stopping even very strong trending moves down. you can see that once price starts to approach secondary support, bears are losing momentum. They are getting exhausted, and very often price would turn back up even without touching the secondary support. In that particular case, you can see that secondary support got tested twice and bears cannot break under that level. But remember that those levels are calculated and drawn for every single day. Once a daily session stops at 4 p.m., those levels get recalculated, and new levels are calculated for a new overnight session and for a new session for the following day. So we can see that at 6 p.m. New York time, the indicator drew new levels, and under those new levels, secondary support moved much lower. So for that day, we can see that bears could not push price lower than 37.60, its ES mini, because this is where secondary support was located. But for the next day, price secondary support level was much lower, and that created opportunities for bears, and we used that opportunity. Just look at that strong trending move down and look where it stopped. It stopped right at the secondary support, new secondary support for the next day. That's another interesting example of Apple 15-minute chart. We can see that we have 2 days on the chart, one day and it's another day, and we can see that the first day bears managed to close the day with price under the daily support. So that was a great sign that price is trending down. And once a new overnight session started, we can see that price started to move down, and it kept moving down until it hit a fresh secondary support drawn for that day. And again, bears managed to overshot that level, but only for a limited period of time, and then price jumped back up over the secondary support, because every time when price drops to the secondary support, both bulls and bears understand that price dropped too low too fast. We understand that price got oversold. After declining price hits the secondary support, it's becoming very hard for bears to keep pushing lower. For every trading day, first 30 minutes from 9:30 a.m. until 10 a.m. is a very important time. This is when bulls and bears try to break support and resistance. If price managed to break under the daily support in the morning, they can push price all the way down to the secondary support. So if we have a test of the support overnight and bulls fail at the test, the bears would start pushing down, and the normal target for them would be the secondary support. And the same but inverse logic applies to the secondary support. You can see that bears tried to break under the secondary support, they failed. Bulls pushed it back over. They got inspired by that victory, and they managed to produce a strong counterattack. And the essential normal target for any counterattack in case when an attack of the secondary support held would be the daily support of the day. So essentially we can see that price keeps bouncing between those levels. Again, in a downtrending market, price spends a day under the daily support and at or over the secondary support. This is a daily range between daily support and secondary support when we deal with a bear market. But any downtrend normally is followed by a range-bound day, a day when price is consolidating. Again, when price reaches the secondary support, that means that's actually clear for all participants that the market gets oversold. And when the market gets oversold, it does not necessarily mean that it will turn back up and start to rally. Normally what happens is that price starts to consolidate to spend some time letting market participants to accommodate to new price levels. They kind of mentally accept those new price levels, and this is why on the chart you can see that two downtrending days were followed by a range-bound day when price spent a day in between of the daily resistance and daily support day. That's another example that when bears managed to push price into the secondary support, they could not push it much lower. So price was oscillating around that level until bulls realized that bears ran out of gas, they got exhausted, they stepped in, they started to push price back up, but they could only manage to push it back up into the daily support that turned into resistance because price started the day under the daily support. When price opens the trading day under the critical support, that level turns into an important resistance for the day. While bulls may try to push price over that level, bears would normally try to defend that level because as long as they hold price under the daily support, they keep alive bearish bias for the day. If they keep price under the daily support, they have a setup to trigger a strong decline driven by forced liquidations of long positions. And that chart is a perfect example of that rule. You can see that bulls managed to push price into the daily support that turned the resistance. But again, it's a never-ending war. And when one party fails in a battle, immediately the next party starts to counterattack. And that's a great example of that. We can see that bulls failed at that level, immediately attracting bears that started to push price back down to the next level. And the next level again would be the secondary support. And again, once price reached the secondary support, bears got too exhausted to keep pushing it lower. The secondary resistance, the upper red line, is a very strong resistance. That is a level which is capable of stopping even very strong trending moves down. Look at that incredibly strong bearish reaction after testing of that secondary daily resistance. Another example, we can see that price started the day over the secondary resistance that turned into support. Bulls got attracted by that bear's failure. We started to push price up until it reached the secondary resistance. And again, bulls got so excited. We got so sure about the strength of the rally that we managed to push price over that level. We overshot the secondary support, but not for long. After 1 hour, price dropped back under that level and it dropped back down to the level where it all started, to the daily resistance. In an uptrending market, price spends a day normally over the daily resistance that turns into a daily support. You can see that price found support at daily resistance here, and once bears failed at that level, immediately bulls produced a strong counterattack that always targets the upper red line, the secondary resistance. It got tested twice. Sometimes we have very strong reversals. Those 2 days the market was in clear uptrend. Price held over the daily resistance on that day and on that day. But that was an FOMC day. Price spiked to the upper level, to the secondary resistance. Bulls failed at that level and bears got attracted by that failure. We turned price down. We pushed price into the daily resistance that was the support for the uptrending market, and you can see a very strong initial bullish reaction. Look at that long tail that tells you that that weakness got bought out, but then bears pushed down again and bulls could not hold that pressure on the second attempt, so that level got broken. And once it got broken, what was the next target? The next target was daily support. Again, you can see that price touched the daily support, bounced, touched again, bounced. But after 2 bounces, bears tried again. We pushed it into that support, we broke under that support, And what was the essential normal level for the next leg down? Right, the lower blue line, the secondary support, and that level got hit. One strong daily move may break the neck of an uptrending market and test the secondary support. We don't have many days like that, but from time to time we get such strong reversal days when price travels from the extreme upper red line, the secondary resistance, to the extreme support of the lower blue line, the secondary support. When price drops to the secondary support, both bulls and bears realize that price dropped too low and too fast. They realize that the market gets oversold. This is why price normally starts consolidation. And that's a great example of that. Look, after that strong reversal, when price traveled in one day from the extreme overbought condition to the extreme oversold condition, from the upper red line of the secondary resistance to the lower blue line of the secondary support, look what happened the following day. Price started to consolidate. It was going anywhere because the following day levels got recalculated and price spent a day well under the secondary support. This is when your chances to go short are very low. I mean, like, you can go short, but your winning rate will be low because you go short when the market was already oversold. What you want to see for a short, you want to get a failure. Remember, big moves are born by failed moves. So you want to see bulls trying to recapture a resistance or broken support that turned into resistance like here, and if we fail, that becomes your new short support. The market is still in a downtrend because it closed the day here under daily support, it closed the following day under the secondary support, confirming that the market was still in a downtrend, and the next day bulls try to push price over the daily support. So we opened the day under the daily support, confirming that the market was still in a downtrend, but we failed to recapture that level. We tried to move price into the daily range in between the daily resistance and daily support. We failed, and that failed move up becomes a start of a new move down. The cycle trader indicator recalculates support, secondary support, resistance, and secondary resistance immediately after closing of a regular trading session at 4 p.m. Eastern Time. That essentially means that we perfectly know what would be those levels for the following day. Price may spend the day at an oversold secondary support level, but at 4 p.m. Eastern Time, all levels get recalculated, and price may start an evening trading session over a fresh daily support. At the same time, a fresh secondary support will be located on a much lower level. That means that we should always start looking at fresh support and resistance for the following day when we start getting into the close of a regular trading session, let's say around 3 p.m. Eastern Time. If you want to use those levels, and if you want to use CAD Cycle Trader Indicator, you can get subscribed, and you need to go to www.monkeymakesmoney.com, or you can subscribe to Elliott Wave Analysis at www.castawaytrader.com. For subscribers of the Harmonic Elliott Wave Analysis, if you pick one of those 3 plans, you can get a bonus, a free access to powerful suite of TradingView proprietary indicators. Those 3 subscription plans will provide you with complimentary access to a dozen of proprietary indicators for TradingView. Thank you for your time, and please subscribe to my YouTube channel and click that bell button, and you will get notified every time I post new videos.